Hello friends, today we will study the very important questions of finance management. Question number 1, who is the father of net income theory? David Durant. Question number 2, which method of capital budgeting is based on the ad hoc decision about capital expenditure? Degree of urgency method. Question number 3, mutual fund scheme is based on net assets value. Traditional theory is related to capital structure. Financial leverage is computed between EBIT and EBT. Corporate governance deal with the value creation for shareholder. Part of capital not represented by assets is called watered capital. Dividend policy must be flexible. Shareholder fund plus long-term fund is equal to capital employed. Contribution divided by earning before interest and tax is equal to operating leverage. Question number 11. A risk-free stock has a beta value equal to 0. 360-degree method relates to performance appraisal. The degree of financial leverage reflects the responsiveness of EPS to change in EBIT. Cost of capital from all sources of fund is called composite capital. Expand WACC, weighted average cost of capital. Another name of working capital is circulating capital. Which approach assumes that there are no tax? MM approach. When was MM approach introduced? 1950. Scrutiny of financial transaction is called auditing. Which ratio indicate the relation between loan and capital? Capital gearing ratio. Question number 21. The only feasible purpose of financial management is wealth maximization. Financial management process deals with financial decision. Finance functions comprises procurement and effective use of funds. Time value of money indicate that a unit of money obtained today is worth more than a unit of money obtained in future. Risk of two securities with different expected return can be compared with coefficient of variation. Efficient frontier comprises of efficient portfolios. CAPM accounts for systematic risk. The value of a bond and debenture is present value of contractual payment is it get till maturity. A bond is said to be issued at premium when coupon rate is greater than required returns. Liquidity ratio are expressed in pure ratio form. Question number 31. Long term of bond maturity leads to more price changes. Overall profitability ratio are based on investment. While calculating earning per share, if both equity and preference share capital are there, then preference share is deducted from the net profit. Which ratio is considered as safe margin of solvency? Current ratio. Current ratio is stated as a crude ratio because it measures only the quantity of current assets. Debt equity ratio is a debt part of long term solvency ratio. As per accounting standard 3, provision for taxation should be treated as an appropriation of profit. Earning yield computed by earning per share divided by current market price per share. Proceeds of company share of sold stock is recorded in common stock accounts. If coupon rate is equal to going rate of interest, then bond will be sold at par value. Question number 41. Falling interest rate leads change to bondholder income, which is reduction of income. Bonds issued by corporation and exposed to default risk are classified as corporate bond. Beta reflects stock risk for investor, which is usually individual. In regression of capital assets pricing model, an intercept of excess return is classified as Jensen's alpha. Situation in which companies replaces existing assets with new assets is classified as replacement project. Nominal interest rate and nominal cash flows are usually reflected the inflation effect. Situation in which new business reduces an existing business of firm is classified as cannibalization effect. Project which is started by firm for increasing sales is classified as new expansion project. Registration of a joint stock company is compulsory. Financial risk is related to capital. Then friend, I hope that it will be very useful to you. Therefore please share, subscribe and like our channel for getting the notification of our new videos. Thank you very much.